Have you ever wondered what's really going on inside a big, successful company? Well, today, we're giving Gopal Snacks, a giant in the Indian snack food world, a full financial health checkup. We're going to pop the hood and look at that classic balancing act every business faces, the tightrope walk between fueling massive growth and managing risk.
You've probably seen the Gopal brand everywhere, right? If you're in India, they're a household name, famous for everything from traditional namkeen to wafers. And that's exactly why we're using them as our case study today. Their success is what makes the financial story we're about to uncover so fascinating.
And believe me, this company has been on quite a journey. It started out small back in 1999, became a private company in 2009, and then, boom, in 2023, it went public. Every single step on this timeline is a signal of bigger ambition, a major move to become a true national player.
Their success is really built on this massive product list. We're talking the whole shebang. Traditional snacks, modern wafers, even things like spices and noodles. It's a smart move. It gives them a huge market and pretty stable demand. But, as you're about to see, feeding a growth machine like this takes a whole lot of fuel.
Okay, so let's get right into it. On the surface, everything looks fantastic. Sales are climbing, the brand is strong. But are there some growing pains happening behind the scenes? Are they affecting the company's financial health? We're going to peel back the layers and see what's really going on.
And that leads to a really fundamental question. Growth is always a good thing, right? Well, it's not quite that simple. Growing super fast and put a ton of strain on a company's finances. And our analysis of Gopal Snacks is starting to show a few symptoms of that exact pressure.
Okay, so symptom number one is rising debt. To keep that expansion going, to keep the factory running and the shelves stocked, the company is relying more and more on borrowed money. Now, that's not always a bad thing, but it definitely dials up the financial risk.
Symptom number two is something called liquidity pressure. Think of liquidity as your company's ready cash. The data suggests Gopal might have a tough time paying its immediate bills without having to find more financing. It's kind of like having a valuable house, but not enough cash in your wallet for groceries.
And the third symptom? A margin squeeze. See, Gopal's profits are super sensitive to the price of their ingredients. When the cost of stuff like edible oil or gram flour goes up, their profit margins get squeezed. That makes their earnings just a little more unpredictable.
So we've got our symptoms: debt, liquidity, and margins. Now it's time to run the diagnostic tests. Let's get under the financial hood, look at the hard numbers, and see what they're really telling us.
All right, don't let the numbers overwhelm you. This table tells a story of two competing trends. On one side, you have reserves. That's the company's savings from profits, and they're growing nicely. That's a sign of a healthy business. But look right next to it at total debt. It's climbing at almost the exact same pace. This is the heart of the story. The company is earning more, but it's also borrowing more.
And here's that same story in a picture, which makes it even clearer. The green bar, net worth, shows the company's value is shooting up. That's the growth we've been talking about. But that red bar, total debt, is growing right along with it. This visual just screams it. The company is getting more valuable, but it's also getting more leveraged.
Now, let's talk about the good news, because there's plenty of it. This is their profitability. Look at total revenue. It's just a beautiful upward climb. But the really crucial number here is the net profit margin. See that big dip in 2021? That was likely due to all the pandemic-era supply chain chaos. The key thing, though, is how strongly it bounced back. That signals a really resilient core business.
And the big headline number is right here. A whopping 135 crore rupees in profit after tax for 2025. That is their most profitable year ever. So yeah, the company is making more money than it ever has before. Which brings us right back to our central question, what's the real cost of that growth? To answer that, we've got to decode a really key concept, financial leverage. This is where we figure out what all this debt really means for the company's health and, more importantly, its future.
So what exactly is leverage? Simply put, it's just using borrowed money to try and make even more money. It's an incredibly powerful tool. When things are going well, it turbocharges your profits. But when things go badly, it magnifies your losses. It's the ultimate financial double-edged sword.
Okay, these numbers tell a really fascinating story. Just focus on that first column, DOL, which stands for degree of operating leverage. See how it jumps way up in the latest year? That means their operating profit has become much more sensitive to changes in sales, a direct result of their expansion. However, now look at the DFL, their financial leverage. It stayed super low and stable. This tells us something huge.
While their business operations have taken on more risk to grow, they've been really conservative with their debt to balance it all out.
You know, it really helps to think of leverage as two sides of the same coin. You've got operating leverage, which comes from your fixed costs, like factories, and then you have financial leverage, which comes from debt. What Gopal has done is carefully manage this trade-off. They've accepted more operational risk to grow while keeping their financial risk from debt on a tight leash. And this quote from the source analysis just nails it perfectly. The key point is that Gopal's success isn't from some clever financial trickery with debt. It's coming from the real stuff, just being incredibly good at making and selling snacks efficiently.
So if the company is being so careful, what's the real upside to taking on all this debt? Well, there's a pretty big one, and it's explained by a Nobel Prize-winning idea. In simple terms, because the interest you pay on debt is tax-deductible, that debt creates something called a tax shield. It literally shields some of your profit from the taxman.
And here's what that looks like in actual money. In 2025, that tax shield saved Gopal Snacks over 7.4 crore rupees in taxes. That is real cash that goes right back into the company, all thanks to a strategic use of debt. It's the silver lining.
All right, we've run the tests, we've analyzed the results. Now it is time for the final diagnosis, and, most importantly, the prescription, a clear plan to make sure Gopal Snacks has a healthy financial future. So, the final diagnosis pretty much confirms what we suspected at the beginning. The debt is definitely rising. Cash flexibility is tight, their profits are a bit vulnerable to outside costs, and, yep, the company is relying on borrowing to manage its day-to-day cash. These are the absolute classic growing pains of a successful, expanding company.
And here is the prescription. The source report lays out a crystal-clear 5-step plan. Basically, keep debt in check, get a much better handle on cash, be smart about paying out profits to shareholders, control costs like a hawk, and make that cash flow way more stable. It's a solid, holistic plan for long-term financial health.
And this brings us to our final question, and it's one that applies to any ambitious business out there, big or small. Where is that perfect balance point? How much debt is too much to fuel growth, and how much caution is too much, risking that you fall behind? That, right there, is the billion-dollar question.